I had a long talk with a fuel director yesterday, and that utility has been very proactive in signing midterm, long-term, buying spot material. And, this person was convinced we may have passed the point of no return on bringing on new production. I mean, if you believe the demand forecasts at all, you don't even have to triple, you don't even have to double. Basically, for the current fleet with some expansion with SMRs, you need more production. Well, we're not doing that. The utilities are not choosing to support greenfields developments.
Hello everyone and welcome to another edition of CEO and Market Expert Interviews. I'm your host Lucian. Most of you know me as Triangle Investor for social media. We are joined today by highly respectable uranium and nuclear energy expert. No need for further introduction. Dustin Garrow, welcome back, my friend.
Thank you very much. A very excellent time to have a discussion.
Couldn't agree more. I usually announce my interviews few days in advance, and I got to say I got a lot of messages about this interview where a lot of people are very, very excited to see you in my show and to discuss the broader nuclear and uranium market challenges, if I may say it. Of course, I am one of those people too. Always enjoy talking to you. That said, for starters, I want to pick your brain, your 40 years of experience brain, to tell me more about the uranium market we have today. Where are we in this bull cycle? Or some of the people would ask, are we in a bull cycle? How do you view it?
Okay, well, as you know, my focus is primarily the term market, which drives future supply availability, development of new projects. I mean, no secret there. So why don't I touch on that first,
Sure.
And then we'll get to the current spot market. So, but yeah, term obviously strengthened last year, very early in the year. We started out around 70, and then we got to 80 by the end of the first quarter. And then the price pretty well has flattened for the last year. And, what are some of the reasons for that? I think the utilities are, let's use the term, uncomfortable with an $80 plus term price. They have, I think, some challenges in understanding the cost structure in this future supply curve. And, to their credit, Cameco, made a very, I think, clear discussion of it on their last quarterly, that $80 isn't enough to incentivize the vast majority of greenfields projects. So you see, DASA's moving ahead. They've got, I think, 3 or 4 contracts in Niger. NextGen announced some contracts not long ago, total of 5 million pounds over, I think, 5 years. So, small commitment, but I think management wanted to show that they were acceptable to the utilities. But the thing is, when you do contracts that are linked to the market at time of delivery, really doesn't give you any price discovery. You can look at the floors and ceilings and all that, but it really doesn't give you that, say, $80 number. So what we're seeing is, with all the uncertainties in the market, okay, we've got, and we could spend a long time talking about them, but the Trump administration with their tariffs on Canada in particular. China now, enriched product has a 17.5%, I think. It's easy to lose track because, as you know, Mr. Trump tends to he likes to disrupt. And so they'll announce something and then, well, we're delaying it. Well, now we're withdrawing it. Well, now we're in negotiations. Like you said with Canada, that tariff on energy could go away because they're in negotiations with the Canadian government. So I think that's one of the factors. The other is the war in Ukraine. I mean, now we've got a ceasefire on the table that's up to the Kremlin to accept. But some of the thinking in the industry is, well, wait a minute, what happens if there is peace in Ukraine and all of a sudden Russian nuclear fuel will then be acceptable into the US and to the EU? Now, I know Cameco addressed this a bit because they're keeping an eye on it. This was always viewed as a potential threat going back to literally the World Nuclear Fuel Market meeting in Montreal in 2022, where it was brought up is be careful if you're a Western supplier to expand without the commitment of the utilities, firm take or pay commitments, because you never know what's going to happen on the geopolitical front. So there's two kind of aspects to it. Again, is the U.S. ban on Russian uranium, which is supposed to be 100% starting January 1st of 2028. And prior to that, there's the waiver environment. Now, of course, as you know, the Kremlin countered that by suspending the blanket export permit. And so there were some deliveries that didn't make it late last year. I think there were 3, and 2 of them, the cargo didn't make it on the ship. And I heard it was as much as 2 million SWU. So it's pretty big shipments that didn't happen. But then, since then, there have been other shipments that have taken place. The point being is, under a Trump administration, will there be an extension of the waivers in the U.S. for maybe a couple of years through 28, 29? Because keep in mind, those contracts start to expire by later this decade. Okay, so there's that uncertainty. And this is, on the supply side and the utilities. Will they be getting the remainder of their Russian deliveries? The other, which I find really interesting, is downblending HEU. I lived through HEU 1, which took into account a large percentage of Russian weapons material. Very controversial at the time. The Duma was not convinced this was good national security decision. And so now it's like, well, Trump has said China, Russia, and the US should sit down and move toward nuclear disarmament. Okay, which is always a noble endeavor. Who can say that's bad?
Exactly.
But then you step back and you say, well, do you think those 3 countries are going to somehow downblend? Now, keep in mind downblending. The original HEU agreement required a lot of, it happened to be low enriched, 1.5% uranium, to downblend the 90% weapons material. So you have to say, well, there's got to be abundant non-HEU material to even get into the downblending. And the U.S. doesn't have any capacity to do it. We can downblend a little bit. Anyway, but then again, it's like, oh, well, now, wait a minute. What if there's an HEU 2? What does that mean? So I think what we're seeing is, again, those geopolitical issues, which there's no real answer to. And so I think this is leading to kind of a, let's call it a stagnation of the term market at a price that does not incentivize greenfields developments. We're coming to the end of, let's say, the restart phase, where we've had, as you know, all the producers, be it Energy, be it Encore, Cameco restarting, Paladin, Peninsula, you run down the list. Some of those restarts are struggling. Mm-hmm. Now, is it because of a mismatch to some degree between the objectives of management on restarting a project that exists, but may have been shut down for, let's pick 10 years? Well, it's not simply flipping some switches and it goes back to where it was. Looking at Encore with Alta Mesa, I was there when the project was built. So, and worked very well, probably the best ISR project in South Texas. But then when you go in and restart, they've fallen short of their targets. Not to say they won't get there, but they had to enter the spot market last year, buy some pounds, had some financial implications to the point of the senior executive being removed, which, shocked the industry, let's put it that way. So we've got the restart struggles in some point. I had a long talk with a fuel director yesterday, and that utility has been very proactive in signing midterm, long-term, buying spot material. And, this person was convinced we may have passed the point of no return on bringing on new production. I mean, if you believe the demand forecasts at all, you don't even have to triple, you don't even have to double. Basically, for the current fleet with some expansion with SMRs, you need more production. Well, we're not doing that. The utilities are not choosing to support greenfields developments. And his point was it takes years to build these projects. And so we may now be kind of in that next phase of how do we get from here to the end of this decade? We'll have to wait and see. So that's a term market. We see, a lot of reasons why the utilities are not aggressively coming in the market. Now, there is a school of thought that says maybe by mid-year, they said there's a conferences coming up in Montreal, one in Sydney in June. In that interface with the suppliers, do they go, well, maybe I better get out there and start? We'll just have to wait and see. The spot market, as you well know, in 2024, the price was above 80 up until the last 2 months of the year when it started to weaken. I think November was 77. I don't know anyone who expected the price to get to, let's pick 65 as a current level. But what I'm seeing and hearing, which I find, let's call it mystifying, is there are those that are now kind of dealing with the $65 spot as the new normal, that the price is going to be, that's where we are for the foreseeable future. And it is encouraging some carry trade. I'm hearing that there are some traders that are offering material, say 2 or 3 years out, certainly at prices below that $80 term price. And one thing, maybe the viewers want to run their calculators. What I was told is if you take $65, escalate it by 7% a year as a holding cost, and you take term at 80 and escalate it at 3%, which tends to be the GDP indicator, you don't cross over until about 2029 or 2030. So it's hard for term suppliers to appear to be competitive at, let's pick $80 against a $65 spot price. And I said, well, wait a minute, how much material is available? And he said, not much on the carry trade. He's doing small 100, 200,000 pound deals out in the future. So, and none of that supports future production. So we're just in one of those, I'd like to think as a mini phase, hopefully, of the market where all of these things are being looked at, discussed. What should we do term contracting wise? We've got the Trump tariffs. We've got, peace potentially in Ukraine. We've got Niger still, as a, um, excuse me, as an issue. I'm sorry, I got to shut this off.
Sure.
All right, enough of that. So that's kind of where we are on the market. I mean, it's kind of in a stalled phase, let's put it that way. And again, spot, not a lot of volume. We have that decline continuing. And so then you begin to look at, well, what is the future role of spot? Will it get bigger? Will it ever get back to 80, 90, 100 million pounds? Usually the spot is driven by excess inventories. I worked for a big trading company back in the 90s, and it was all about excess inventory, which we don't see now. So, will the spot kind of stay volume-wise 40 to 50? Could. And again, as UX pointed out, if you look at the sales side last year, 94% by volume was financial intermediary participants. So it's not the producers, it's not utilities selling in the spot. So we see, the markets are changing across the board. So again, a challenging time, an interesting time trying to figure out where we're going to be even later this year.
Yeah, just like you said, the spot market essentially majority of transactions are recycled sales going back and forth, not finding a final buyer. However, it turns out to be that the spot is very important as a retail indicator, since with every pullback we are seeing equities follow that. Do you agree? I mean, you don't have
Yeah,
to.
I think, what I've learned over the years is the investment community focuses on the spot price as an indicator of the uranium market. I can argue that's not appropriate. The term market is really the principal market, but that's, they can do what they want. But I think as Grant Isaac pointed out, the depressed spot is leading some buyers to argue that the floor in term contracts with a collar shouldn't be that 70, 75. It should be maybe in the high 60s. So they're trying to use that to depress the floor price. So it does have a role that it plays, but not, again, as you know, the volumes are all term contracts. So
yeah, I got actually a good question. When the uranium spot price peaked at $106, that was in early 2024, who was pushing up the price? Who was buying and why?
Well, people like the Chinese have been buying a lot. The financial guys were adding to their inventories. I understand as a group, they're holding, this is the non-traders, could be holding, 15 million pounds or more. So again, when the market's really thin and we have, for example, some demand show up, I was told the other day, if you wanted again to buy 1 million pounds, good luck. You probably couldn't find it without really forcing the market up. So I think that's what we saw is, some utilities adding to inventory. The Chinese are still looking to buy. Some of the financial guys, some of the producers. When did Encore buy? Did they buy in the first, in that period? Could have. So, there various actors show up.
Exactly. There is some speculation that the Japanese are supplying the spot market. Any truth in that?
Historically, yes. There was a lot of discussion post Fukushima on what were the Japanese going to do with their inventory. I've been told that they sold at least 25 million pounds, but that was through, like 2013 to 2020 or so. Actually, the Japanese are now looking for fuel because as they sold down some of their inventories, they're now out. I think we've talked about it. They've sent Itochu and Sumitomo out to look at investing in production, and they lent a lot of pounds out that to some big producers that will have to be returned in the future. People don't really focus on that. But yeah, so the Japanese have kind of switched, and you bring up Japan. You may have seen they just approved their new 3-year basic energy plan, and it's moved away from, well, we want to minimize nuclear to, oh no, we need to restart virtually the 36 reactors that are still operable and build new reactors in order to meet their revised target, driven to a great degree by hyperscalers. Everybody's still kind of dealing with that aspect of the market kind of off to the side. But, EDF just announced they're in discussions with hyperscalers on providing nuclear generation. So it's spread globally. I mean, it's unbelievable, but it hasn't yet been seen in the fuel markets. But I think that's coming. So.
Yeah. Dustin, when it comes to the term market, what are you hearing about this year's numbers, about the RFPs, contract volumes, and of course, ceilings and floors in the recent contracts?
I think that the term market will have higher volume, but keep in mind, as was correctly pointed out, the last couple of years, there have been very large contracts signed. In 23, it was Kazakhstan with Emirates. Last year, China. I mean, they didn't release the numbers, but the estimates are 40%, which would be almost 50 million pounds, was signed by the Chinese utilities in Kazakhstan. So then you back that out and you say, well, how about the Western utilities? Pretty minimal. The U.S. guys I've heard numbers like in 25 million is all. Now, that's for future delivery, and so we get to the replacement rate idea. And, people are focusing on the U.S., the largest uncovered market still, and they're only covering about half their annual burn in future delivery contracts. So they are lagging behind on coverage for all the reasons and more that we've gone through. And, how are they doing that? Well, they're drawing down inventories. They're maximizing flexibilities under existing agreements. You name it. They're pulling every lever they have, modifying anything they can on enrichment to reduce the amount of feed delivered, you name it. But eventually, and Sprott pointed out in their monthly analysis, that runs its course, where at some point you go, well, we don't have all of those safety nets that we can pull. So I think term volume will pick up. There's speculation that we will move through the $80 phase fairly quickly. There have been small contracts done in the mid-80s. I was aware of one at 84, but it was an established producer, fairly small delivery volume, and it was US. And so that was, so we've had contracts done above the published price. Again, keep in mind the published price reflects the lowest offer that the price reporters are aware of.
Yeah,
and
people
I
do
think
not know that, actually.
And there's one restart that's out offering around that 80 to fill out their portfolio. So that sets the market, okay? And some of the utilities say, well, $80 is the market. So the sense is looking at the cost structure, looking at exchange rates on currency, we could move into the 90s fairly quickly. And then do we have another phase of stability where there are producers that say, yeah, maybe it's going to go higher, but I'll put some of my material to rest, in a $90 market? So we're kind of getting at that level where, yeah, we'll start covering some project costs, but then the management and boards have to step back and say, we don't want to forego much upside. Okay. In other words, if this market takes off, I don't want to focus on Cameco, but if you look out in 26 and the spot's 140, they get 77. So I mean that's a pretty big margin that some people would say they've given up. And some of the other guys have done it too, and so you want to be careful. You don't want to do that. Okay, now looking at the callers, I mean, when you go out, like Cameco, they do hybrid contracts. Part of it is defined price. The other part is market at time of delivery with a collar going out, usually a floor and a ceiling. Well, the floors had gotten mid 70s. Some I'd heard at 80. And the ceilings had been 130 and up to 150. If you really look at the next gen announcement, it looks like their ceiling they put on those contracts was about 150. The word is, as I said earlier, some of the buyers are countering now saying, oh, the floor has got to be lower to kind of reflect the current spot. And so, I think as Grant has said, there's been that downward pressure, and ceilings are still around the 120, depending on the supplier. If you're an established supplier, you're in production, you're going to get a marginally better deal. If you're a greenfield producer, you will probably be at the lower end, which is 120 probably, when the utilities want to negotiate.
Yeah.
So right now it's kind of a theoretical exercise because nobody's actively. Now you mentioned RFPs. Keep in mind, if you really go back and look at the data, most of the term contracts, I think about 75% by volume, have been done, quote, off market. Mm-hmm. Now, what does that mean? That means the utility has a list of qualified suppliers. They go privately to the suppliers and say, okay, we want to cover 2028 through 2030, whatever. Send in your offers and we will negotiate with the selected suppliers. So it's not like some of the U.S. utilities, for example, have to do broadly based formal RFPs because they're, for one utility is totally regulated by state regulators. So they have to go in and show that they did a broad-based request. Mm-hmm. If you're outside of state regulation, you can do kind of whatever you want to do. One of the obvious formal RFPs were the Koreans. They would come out with a 60, 70 page RFP with virtually all the terms and then let you plug in a little bit on pricing, but they'd say, oh, you've got to be kind of in this range. They did this in late 23 and did not receive the kind of response that they wanted, because historically they had. Okay. They've gone to the kind of off-market negotiations. I've been told they were in the market 3 times last year in order to fill out that volume that they were looking for. And we're seeing more U.S. utilities do that. Less kind of formal set dates. They're in the market now constantly talking to suppliers. And like they've said, when I see a transaction I like, I'll pursue it, as opposed to a formal chronological, kind of procurement. So again, another factor, we talk about the markets changing.
Yeah.
How the utilities buy their fuel is in some cases now changing. They'll be in the market kind of on a constant basis. They'll buy spot, midterm, long-term, different endpoints on contracts, you name it, different pricing. As one of the price reporters came out Friday, then you know which one it is, and said we've seen some single term deals done. And I was told recently there have been some single delivery deals in 30 and 31 because it fit a procurement strategy that's more, not to get off on it, but in the old days, procurement, there was a cycle. The utilities came in generally in masse, and they would do their contracts and then disappear. So if you didn't get involved in the cycle as a supplier, you tended to miss out on those contracts. That is now changing because of the nature of the market. So
yeah. Dustin Grant Isaac from Chemical recently said that between now and 2040, utilities will have to buy 2.5 billion pounds of uranium in order to meet their run rate requirements. The requirement curve does not factor any SMRs or similar stuff. Is your math in line with that?
Yes, I understand that the latest UX, who they quote, quarterly, now that is the base case going out, which doesn't show, because, UX does publish a high case. Mm-hmm. And I understand if you then add that increment, that number becomes like 4 billion pounds. I mean, it gets mind-boggling. It's just like if you triple nuclear by 2050, you've got to produce like 500 million pounds a year. So you go, well, how does that happen when we can't produce enough to supply really the current fleet? What is the effort required in order to do that? So if you look, the Department of Energy does an annual survey of U.S. utilities, and you have to answer truthfully, as a utility. And if you look at that, they published it in May. The number's fairly large over the next 5 or 6 years. So there is a very big uncommitted component in the future market. While the big suppliers, a Cameco, they've been doing large contracts. Kazatomprom, we've talked about them. Where are they going in the future? So there's going to become, I think, a fairly heated competition for available pounds in not the too distant future. And it's not just me. I mean, everybody's kind of coming up with that conclusion. And then if you ladle on, like you say, SMRs, more large reactors, you name it, the situation just gets worse, which gets to, me, I tend to get off a little bit. Grassroots exploration is now been talked about. I think we talked in London about it, that the subcommittee on uranium is saying, well, wait a minute. When we get out to 2040, where they stop their report, you've got to be looking for more material. Well, where? Canada, Northern Australia, South America, Central Asia. You've got to send out the geologists that are trained in exploration. These aren't the guys that are in production.
Yeah.
There's a different group that runs around with, Geiger counters and, like back in the 50s. And we don't see a lot of that. And who's going to fund it? Yeah. Will the utilities pay enough for the new contracts to provide enough funding for the producers to send out that group? So, it's everywhere you look, you go, there's got to be significant focus on the uranium sector. Not just, incremental, a little bit here and there. Yeah. It's got to be a major push. And we're yet to see that.
Yeah, yeah. Dustin, final question. Where do you see next M&A activity in the sector, and do you see more M&A in 2025 with these reduced levels of company valuations?
The answer is yes. It's almost so obvious. I haven't really reviewed the market cap on some of the, say, the U.S. companies. It's almost too obvious. I'm hearing rumors in the Athabasca that the big suppliers, the producers that are there, that for years said they really weren't looking at M&A, may have kind of decided we'll get out and begin to look. I mean, will it take place in Australia? Sure. I mean, you really can't do it in Kazakhstan.
Yeah.
Uzbekistan already has too many people running over each other. Same with Mongolia. So will it be, again, US, North America, South America? Sure. I mean, again, if the market stays kind of where it is and the equities remain under pressure, which they could if the spot doesn't improve, we could start to see quite a bit more activity in the M&A area. Even when prices were higher, there were those saying you've got to consolidate. You can't have a bunch of little producers out there. It used to be £1 million was a magic number. So you had a lot of smaller guys. Then it got to 2 million. And now it's, well, you really have to have 5 plus to have a place in the market and being able to go out and maybe do grassroots exploration or whatever. So, we could see that group, that segment of the production sector grow, but remains to be seen. So
Yeah, and those small mines are usually in the United States, and those companies that you are pointing to, if I'm not mistaken.
yeah, and then to some degree it gets on processing capacity.
Yeah.
Shootering Canyon, a small mill in Utah, operated years ago. It's now kind of a focal point. Sweetwater in the
Mhm.
Red Desert of Wyoming, again, both of those were built with utility funding. That's another story that we talked about before. They're being re-examined. The one at Sweetwater in the Red Desert's a huge mill because it was designed for low grade
Yes.
red desert ore. So, they're beginning to look at that. The other's White Mesa, which, has got uranium, strategic minerals, all kinds of things that they'll be handling. So we've got that, it's just, to some degree, it's overwhelming. Some degree, it's hard to imagine how that all comes together. But I think there'll be significant opportunities.
Good.
The point from the fuel director yesterday was, again, when the price correction comes, it's going to be more significant the longer the utilities wait. It's almost too obvious. So that's kind of where we are. I mean, it's interesting, challenging time as we started out with.
Yeah, and we will finish with that. Agreed once again. Dustin Garrow, my friend, thank you for coming to my show. As always, a brilliant chat, and I look forward to host you again.
Yeah, and maybe mid-year after we have the conferences and stuff, we'll see some change. So we'll talk soon.